If your overall investment thesis is that the dollar is going to continually be devalued as debt now expands through 40 trillion, doubling about every 8 or 9 years, so it's going to go to 80 trillion, by 2033 or 2034 at a minimum. And the servicing of that debt means you got to keep expanding the money supply and run negative real interest rates. And all these things are fundamentally positive for gold and always have been. Then it's pretty easy to sit back and go, okay, well, I guess there's a reason why gold was 1,000 10 years ago and 2,000 5 years ago and 4,000 now. And I guess as long as, my thesis remains correct, it'll be 8,000, in a handful of years and probably 16,000 after that.
Economic stability hinges on understanding how rapidly expanding government obligations diminish purchasing power over extended periods of time. As national debt liabilities compound across global markets, traditional fiat assets face relentless inflationary pressures and long-term structural degradation. Craig Hemke, a seasoned financial analyst and market commentator, emphasizes that the fundamental math of a debt-driven monetary system makes continuous currency devaluation mathematically inevitable. With federal debt surpassing $40 trillion and expanding toward $80 trillion over the next decade, monetary authorities must aggressively inflate the money supply while enforcing negative real interest rates. These macro dynamics provide an enduring tailwind for hard assets. Historical pricing reflects this structural reality, rising from $1,000 to $2,000 and currently holding near $4,000. Under these relentless monetary conditions, gold is predicted to reach $8,000 within a handful of years and ultimately hit $16,000 as global debt servicing costs explode. Protecting wealth requires recognizing real physical assets as an unyielding measuring stick against ongoing paper debasement. Now, we present the clips from Craig Hemke's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
In this case, is the long-term devaluation of all fiat currency, but specifically the dollar. If your overall investment thesis is that the dollar is going to continually be devalued as debt now expands through 40 trillion, doubling about every 8 or 9 years, so it's going to go to 80 trillion, by 2033 or 2034 at a minimum. And the servicing of that debt means you got to keep expanding the money supply and run negative real interest rates. And all these things are fundamentally positive for gold and always have been. Then it's pretty easy to sit back and go, okay, well, I guess there's a reason why gold was 1,000 10 years ago and 2,000 5 years ago and 4,000 now. And I guess as long as, my thesis remains correct, it'll be 8,000, in a handful of years and probably 16,000 after that. Regardless of what pricing structure, whether it's here or Hong Kong or Shanghai or wherever, however you want to run the pricing scheme, just that fundamental math of the debt-based monetary system means, like I said, that's my fundamental thesis. And so sometimes it gets ahead of itself. You could look back now and say that's what happened in December and January to some extent, though the war changed everything, obviously, at the 1st of March. But sometimes it's going to get ahead of itself. Sometimes it's going to fall below the trend line as well. But in the long term, I feel pretty comfortable that there's no austerity coming. The only way, nothing's going to stop the train. The only way they can pay off yesterday's debts is with the cheaper dollar of tomorrow. And that means with gold as your measuring stick, silver tooth, then how many dollars it takes to buy an ounce is just going to keep increasing. For the rest of the year, I thought, this is now 6 weeks ago, late June, when prices came cascading down again for both gold and silver. You could see on the chart, there should have been support at around 54, 55 in silver, and there should be support around 4,000 in gold. And that's where we've held pretty well for the last 6 weeks. I thought beginning in late June, we'd reached kind of peak hawkishness in terms of interest rates and, what Warsh was going to do and all this kind of stuff. And again, that's a whole topic for another day as to how, what ultimately where he's headed. But I again, maybe we'll wash out. Maybe there's some unforeseen global liquidity events and stock market crashes, and who knows what will happen. Could cause everything to just get liquidated again in a total flush. We've seen that a few times, like right before COVID. Silver on the COMEX went to 12. So anything like that can happen. But I think the worst is over, and I think by the time we get into the end of the year, the market should begin focusing upon what it was focusing upon when the year began, which is, they're going to run it hot. falling real or inflation-adjusted interest rates, right? Soaring deficits and the Fed looking to cut rates instead of hike. And we'll kind of get back to all of that by the course of the end of the year, which should lead us off these lows. Gold finished last year at 43.25, something like that. So where do we record this? Around 4,100 or so, I suppose, right? So we'd need a 5% rally in the back half of the year to break even. Okay. All right, that doesn't sound too hot, just simply because we were where we were in January. But then again, if we were to look back on a bigger picture, given the historic returns of gold this century, Ronnie Sturfalo always prints his chart in the In Gold Retrust report showing all currencies, 10 or 12 of them, and gold's annual gains or losses since the turn of the century. And the average is like 9%, pretty much uniform across these currencies, which again, they're all being devalued. So why? Okay. And you can see on there have been a handful of really big years in gold, like 25%, in 2010 and 25% in 2020. Usually they're followed by, maybe a slightly green year, and we're trending back toward this mean, whatever, over time. Well, we did 25% in 2024, and we followed that up last year with 63%. So once we get to the end of this year and it's all out in the wash and the war and the hawkishness and all the stuff we've had to deal with in 2026 and nobody really saw it coming. If we get to December 31st and we look back and gold's 4,300 and we go, okay, there's a flat year for gold. But given that it was up 25% in 24 and 63% in 2025, just putting a flat year on from a historical basis would be like, oh, okay, I guess we could see where we were due for that. And maybe that's what, we rally 15% from here into year end, which is certainly conceivable. We'd be up 10 on the year. Just an average year with all the noise in between. So I think there's room for that. And frankly, I expect that here in the back 5 months of the year. These bases, though we could get another little flush, I think we still end up the year, somewhere in the 4,000s for gold and somewhere between 60 and 70 for silver. And then maybe we can get back to focusing on what drove everything and continues to underlie everything in past years. We can focus that again maybe in 27.
Recent market consolidation across precious metals reflects temporary volatility rather than a shift in underlying economic fundamentals. Following notable pullbacks, key support levels held firmly near $4,000 for gold and around $54 to $55 for silver. Despite policy rhetoric and hawkish interest rate sentiment, systemic pressure continues to build across fiscal channels. Annual deficits remain stubborn at nearly $1.8 trillion. Leaving monetary authorities with limited structural flexibility. A 5 to 15% rally during the back half of the year remains probable as market focus shifts back toward falling real interest rates and impending monetary easing. Consequently, precious metals are predicted to finish the year strongly, with gold settling somewhere in the $4,000 range and silver trading between $60 and $70. Hard assets continue performing their essential role amid persistent monetary expansion. Now, let's get back to the interview.
If, the chart looks bad and all that kind of stuff, then don't let it, then you maybe have too much exposure to the sector. You think, well, what else can I be? Well, then pay off your mortgage. There's other things you can do and still stay out of, simply buying NVIDIA, or an S&P fund. There are other things that people, so I think having some type of financial advisor, certified, financial planner, somebody that, and not just everybody, right? Because the normal stockbroker is just going to say, oh, what do you want that gold for? Let's dump that and buy a Mag 7 fund. Somebody that understands, you got to shop around, find somebody whose understanding of where we are in the world matches up with your own. But again, if you're losing sleep and really uncomfortable over what has happened in gold for the last 5 months, silver too, then I would encourage people to take steps to kind of try to mitigate some of that risk going forward. The one thing that we know about gold and silver and physical gold and silver is they ultimately retain their value as measured, versus the dollar, because that's how we price it, right? Dollars per ounce. How many dollars does it take to own an ounce? And that value, that price, and value, which aren't the same thing, but they'll fluctuate over time. However, millennia of history shows us that society tends to revert back to stable sources of value, in pricing your currency. And so I think long-term, continuing to hold some metal, even for your heirs to pass on, is still a pretty good strategy too. Well, going to 5,400 or whatever gold went to is not the ultimate realization of all this. Okay, that was just the most recent price peak. The math that's the math is what we discussed earlier. And that there's nothing that's changed. The U.S., Trump came in with Musk and they talked a good game about Doge and they were going to balance the budget and all this stuff. And then it all just became a non-deal. And then they were going to have all these tariffs, and that was going to help. No, that's a non-deal too. And we're still going to end the fiscal year here next month at the end of September with almost the identical total annual deficit that we ran in fiscal year 2025. We have about $1.7, $1.8 trillion. And so there's nothing stopping this. The implications now for the rest of this year, frankly, which again, we'll talk about next, all kind of flow from that because we're looking at a 10-year treasury that's at, 465. Take a 2-year treasury that's at 4.25, a long bond that's up over 5. U.S. simply cannot afford that. Short term, yeah, maybe it'll still be there tomorrow, next week, next month, whatever. But long term, that is untenable. And again, that's all part of what I think is going to help guide people here in the back half of this year too. Well, I'm the guy probably called 10 of the last 1 stock market downturns, right? I'm also the guy that thought, I didn't think we'd get out of 2011. The first QE program was supposed to be a one-off. And I was like, oh my God, this is so terrible, $700 billion. What's Bernanke doing? And then there was a second QE program and then a third, all these things. And somehow they've kept it going for all these years. So you don't want to run around being Chicken Little all the time because though the sky may fall at some point, it's probably not happening tomorrow. And it's like the old other line that Art Cashin from Payne Weber used to say, you don't want to go around predicting the end of the world because it's only going to happen once. So how long, though, can the plates keep spinning? That's what we don't know. We just have to recognize the plate spinning for what it is. There's just all these dials and switches and all this kind of stuff that the central bankers of the world are trying to, manage just to keep things going. Again, and maybe I don't know how much, maybe they keep going all the way to 80 trillion in U.S. debt, or maybe it's 160 trillion, because there's always people out there that say, well, as long as U.S. owns a majority of it and all that kind of stuff. And, I think back to, I references stockbroker training and licenses I had all these decades ago. We always used to talk about buying bonds, right? A U.S. T-bill or treasury note or whatever is $1,000 face value. And it's backed by the full faith and credit of the government, meaning that even though interest rates may rise over time and your bond value is going to fluctuate, hey, at the end of the 10 years or, 90 days or whatever the duration is, you're going to get your money back. The government has the power to print money. So don't worry, you're going to get your money back. The problem is with that, and again, most people understand this, is that $1,000 you're taking today to buy said treasury note or treasury bill buys $1,000 worth of goods today. But by 10 years from now, when they give you $1,000 back at maturity, that may buy $500 worth of those same goods, because of the devaluation. And that, again, that is what gold is protecting you against. It's the measuring stick. In the 21st century, all of the financial professionals and the media and everybody has been trained to think that the dollar is the measuring stick, right? Even, your New York Stock Exchange, all the shares trade dollars per share. And what's changing is the company, right? The P ratio, their earnings, all this stuff, right? And the dollars per share is what's fluctuating. They think the dollar is the measuring stick. Okay, maybe in that regard it is. But when it comes to gold, the gold doesn't change. We laughed 10 years ago about the New York Stock or the Wall Street Journal talking about being a pet rock. It is. It's just a piece of metal. It's not becoming more efficient over time. You can't do a hedonic adjustment because gold 10 years later now has all these extra fancy bells and whistles on it. No, it's just gold. It hasn't changed. The reason the price changes is it's taking more and more of said currency. The currency to buy it is being devalued. And it used to take 1,000, then it took 2,000, now it takes 4,000, and soon enough it'll take 8,000. So I know I'm repeating myself what I said earlier, but this is the important way to look at it, especially in these times of great volatility.
Navigating long-term portfolio allocation requires recognizing the fundamental contrast between fiat obligations and physical tangible wealth. Conventional financial advisors often train investors to view government paper securities as safe havens because nominal principal amounts are guaranteed at maturity. However, holding 10-year treasury bills or long-term bonds exposes capital to severe purchasing power destruction. While a $1,000 treasury note returns its nominal face value after 10 years, rapid currency debasement guarantees that returned capital will buy only a fraction of the real goods it originally commanded. With government debt projected to expand toward $80 trillion or even $160 trillion, central banks have no choice but to continuously dilute currency values to pay yesterday's debts with cheaper tomorrow dollars. Millennia of monetary history demonstrate that human societies inevitably revert toward stable, unyielding stores of value. Physical bullion serves as the true measuring stick, remaining completely immune to paper debasement or government policy maneuvers. For investors focused on generational wealth preservation, maintaining continuous physical metal allocations to pass down to heirs remains an enduring strategic imperative against irreversible currency decay. As monetary pressure accelerates, precious metals are predicted to continuously appreciate. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.